Hey guys, welcome back to my YouTube channel. My name is Ngobile Shabane and this is Nuggets for Your Wallet, a place where we share pockets of tips and wisdom on personal finance. Thank you so much for clicking on this video, and I really believe that there is something that you are going to learn. The cost of living is going up by day. If it's not petrol prices increase, it is electricity increase. If it's not that, the general price of food and services is increasing. And if it's not that, the repo rate is increasing. And on the 31st of March 2023, the South African Reserve Bank threw a bomb on us by increasing the repo rate by 50 basis points. And if you really understand what that means, you would understand why this has left South Africans crying. In this video, we'll really be unpacking what repo rate is, what prime lending rate is, and we'll just try and understand how it impacts us as the end users and what lessons can we take from this. In order for me to be able to explain these three rates, I would like us to simply explain where does money come from. So money, basically the money that we use is printed by the South African Reserve Banks. The South African Reserve Bank prints out money and then it lends the money to the commercial banks. Commercial banks are your Standard Bank, Nedbank, Absa, your Capitec. Those are commercial banks. So the South African Reserve Bank would print out money and would lend that money to the commercial banks, and the commercial banks would then lend that money to the end consumers, which is you and I and businesses. So that's how basically money flows from the Reserve Bank to commercial banks, from commercial bank to the end users. And I'm just basically simplifying this in order for you to understand. So the Reserve Bank lends money to a commercial bank. And in order for them to lend money to a commercial bank, the Reserve Bank charge a rate to the commercial bank, and that rate that the Reserve Bank charged to the commercial bank is what we call the repo rate, which is the repurchase rate. And currently what the Reserve Bank is charging to the commercial bank to lend them money is a percent of 7.75%. So the commercial banks will then have that money, and once they have that money, they'll say, okay, the South African Reserve Bank has borrowed me, I'm going to make a simple example, have borrowed me 100,000 Rand and they're charging me 7.75%. The commercial banks will then, what they do is they add a markup on that. A markup is basically as an additional percentage to get to what we call a prime lending rate. So the commercial banks add 3.5, an average of 3.5% to the repo rate to get to what we call a prime lending rate. And currently as I speak, the prime lending rate is 11.25%. So once the commercial banks have then basically have what we call a prime lending rate, this is their benchmark rate. This is the benchmark that they use in order for them to determine the interest rates that they would eventually charge to the end consumers. They use the prime lending rate as the starting point. So if you and I or a certain business goes to a commercial bank to borrow money, the commercial bank would say, okay, you want to borrow money from me, let me look at your risk factor. So if you are, say for example, a more risky customer, they will maybe add a 5%. So currently the prime lending rate, as I've said, is 11.25%. So if you come and you are a more risky customer, they say, okay, we're gonna add 5% to the prime lending rate in order to basically determine the interest rate. So in this example, your interest rate that will be charged to you will be 16.25%. But if you're a less risky customer and you come and you borrow money from the commercial bank, they will say our starting point is always the same. It's the prime lending rate, which is 11.25%. And if you're a less risky customer, they will maybe charge you an extra 1%. So if you're a less risky customer, then the interest rate that will be charged to you will be 12.25%. So you now understand there is a repo rate, which is the basic rate that the Reserve Bank charged to the commercial banks. So once the commercial bank have been charged a repo rate, commercial banks will say, we're going to add a markup on that, which is 3.5% markup, in order for them to get to what we call a prime lending rate. And currently the prime lending rate is 11.25%. And then once they have the prime lending rate, which is their starting point, they then are able to charge interest rate to the end consumers. Then depending on the risk factor of each consumer, they would add a certain percentage, maybe 1%, 2%, or they would even minus a certain percent in order to determine the interest rate. So that is how basically those rates are determined. Why do then the Reserve Bank increase the repo rate or change the repo rate? They do that to stabilize the economy and also to stabilize or to control the currency. There is what we call inflation. Inflation is the general increase of goods and services over a period of time, and basically is the reason why bread was 5 rand or 6 rand 10 years ago, 20 years ago rather, and now it's costing 17 rand. It has increased over time because of inflation. And in order basically to control inflation, the Reserve Bank, they then change the repo rates, because once they change the repo rate, it has an impact on the interest rate, and eventually it has an impact on the level of money that circulates in the economy. So currently, one of the mandates of the South African Reserve Bank is to control inflation, and their targets, the South African Reserve Bank target of inflation is to keep the inflation between 3 and 6%. That is their target, and currently the inflation is sitting above 7%. So in order for them to try and control that or to decrease inflation, they increase a repo rate, because when they increase repo rate, basically they make it expensive to borrow money. So if it is more expensive to borrow money, it means that there will be less money in the economy, and if there is less money, it means that then if there's less money, means that there's less people buying food, goods and services, and if there's less people buying goods and services, means that there's less demand of those things, and if there's less demand, then the price of those things will go down, and if the price of those goods and services goes down, it means that the inflation goes down. So that is the whole aim of the South African Reserve Bank increasing the repo rate. You remember that in 2020, the economy was basically sluggish because of the global pandemic that we were facing as the nation, or as the whole nation, and because of that there was less activities in the economy. And in order to boost the economy, what the Reserve Bank did is they dropped the repo rate, which means that it was cheaper to borrow money from the banks. And if it was cheaper to borrow money from the banks, that is why a lot of people started taking out loans, started buying property, because it was cheaper at that time. And if it was cheaper, then it meant that if it was cheaper, we took out money, we went and we then bought houses, bought cars, and that stimulated the economy. And what they did is the South African Reserve Bank, they really dropped the repo rate, and in July 2020, the repo rate hit the lowest point in decades, and it was currently sitting at 3.5%, which made basically the prime lending rate 7%. It was low. That's why a lot of people started buying property and all that. So now, what does this mean to us? It means that if you have a debt from the bank that is basically linked to a prime rate, it means that when the repo rate increase, it means that the prime rate will increase, which means that the interest rate that you get in charge would also increase. So what this means to you and I is, if the South African Reserve Bank increase the repo rate, it means that to borrow money will be more expensive, and if you already have debt that is linked to prime rate, it means that you're gonna be paying more money. It means that other things as well in the economy might be a little bit more expensive, because if the businesses have borrowed money, it means that they need to pay more money. So that's what it means to you and I. But on the other hand, on the same token, if you have investments and savings that are linked to prime rate, it means that the increase in prime rate, it means that you have more returns. So that's what it means to you and I. There are 3 lessons that I would like us to take away from this. What is this teaching us? This is firstly teaching us that it is very important that when you're looking at borrowing money for whatever reason from the bank, please do not take out the maximum amount that you qualify for. Say, for example, you want to buy a house and the bank tells you that you qualify for a 1.5 million house. Please don't go and buy a house that costs 1.5 million, because it means that if the repo rate increase, it means that the prime rate will increase, which means that your interest rate will increase. It means that you will then struggle to service that particular debt because you have taken out the maximum that you qualify for. This is a lesson for us to live below our means. Don't take the maximum amount of money that you qualify for. If you qualify for 1.5 million, take a house that costs 1 million, so that you would have that element of a cushion in times where the repo rate, which eventually means the prime rate, and the interest rate increase. So take less. The second lesson is the lesson of budgeting. Guys, it is now more important than ever for you to basically do your budget, because you need to see where you can tweak and change, because for the next couple of months, at least for this year, I don't see the repo rate going down. Obviously, that is basically looking at the current inflation that we have and the mandate of the Reserve Bank. And if it does go down, it will go down very minimally. So it's very important for you to do your budget. And the third lesson is that if there is an extra money that you have, invest that money, save that money. Put it, diversify your savings and your investment. Put some in places where you get a prime related return, because in that way, if the prime increase and you have an investment that is related to prime, it means that your returns would also increase. Those are the 3 basic lessons that I think we can take away from everything that is happening. This brings us to the end of our video. I really hope that this gives you a better understanding of what repo rate is, what prime lending rates, and how the commercial banks determine the interest rates. If you like this comment, please leave a big thumbs up, and please leave a comment. If you have any question, let's engage in the comment section. And if you have not subscribed to my channel, please subscribe to my channel. I really appreciate that. It really assists for my channel to grow. Please also share this video with your friends and with your family, so that you can all grow and learn together. Lastly, please tell your friends to tell their friends that Nugget for Your Wallet is on YouTube. Thank you so much for watching. Until next time, bye.